Welcome to the Fear and Greed Daily Interview. I'm Adam Lang. It's almost tax time, and without wanting to sound too serious about it, it's time to start getting your affairs in order. I wanted to have a look today at what business owners and investors need to do now to be ready for the end of the financial year. I've spoken previously to Elinor Kasapidis, the Senior Manager of Tax Policy at CPA Australia. Elinor, welcome back to Fear and Greed.
Thanks, Adam. Great to be back.
Thank you for joining us. So up until the end of March, a lot of Australian businesses were receiving JobKeeper. How much does that complicate things when it comes to tax time?
It shouldn't complicate things too much. Most of those businesses already have gone through the process because they were receiving JobKeeper payments last financial year. It's just a reminder that JobKeeper payments are assessable income, so they do need to be reported on the tax returns, and the payments that you've made to employees are deductible.
Okay, so that is included in assessable income, and many businesses were also able to receive a cash flow boost from various federal and state support measures. Are these also taxable?
The cash flow boost that came from the federal government is not taxable, so it's what's called non-assessable, non-exempt income. The state government grants, though, they do vary in their tax treatment. Some are taxable, so it's important to check whether they need to be reported on your tax returns or not. And the ATO has very helpfully published some guidance on that on their website, or your tax agent can help you through that.
Great. So one of the stimulus measures announced by the government during the pandemic was the extension of the instant asset write-off. What do businesses need to know, and what do they need to do if they're looking to take advantage of it?
There isn't that much time before the end of the year, and the thing about the instant asset write-off is that the assets need to be installed and ready for use by the 30th of June. So that means you don't have much time to put that order in and get something installed in your business. For those who can't actually make that deadline, the government has actually extended the instant asset write-off, so businesses have another year to make the purchases. Sometimes it's good just to take a breath, make sure that you do actually need the asset because it's not a dollar for dollar refund. And if it means that you claim it next year, then so be it.
Are there any common traps that you see small to medium-sized enterprises falling into at this time of year?
Yeah, depending on business structures, many businesses operate through companies and trusts, so resolutions need to be done and documented before the end of the financial year, even if the tax return isn't due for a while. So getting that paperwork in place is quite important when it comes to doing your tax. There are also reporting obligations like single touch payroll, taxable payments reporting system that businesses need to get done pretty quickly after the financial year end. And quite often they might detect errors that need to be corrected or some unpaid superannuation, for example, that needs to be fixed. We do say that good tax preparation means not leaving things to the last second. So most businesses, most businesses we'd suggest should have ongoing discussions with their tax agent throughout the year, because trying to rush at the end of the year to make sure your records are in order and pull those digital shoeboxes together can result in errors or maybe not the best decisions when it comes to tax.
Okay, so the membership of CPA Australia, I can imagine that this time of year is almost peak season, coming up, and a lot needs to get done in a compressed period of time. From the CPA members' perspective, what will help them get business's job done for them? So as a small or medium-sized business, what can you do to help your partner in tax, if I can put it that way? What can you do to help them get through this period effectively for you?
The biggest thing these days is digitalisation. So getting onto digital record keeping, making sure that your accounts and your books are kept in order. The other thing as well is actually having a talk to your tax agent before you undertake a transaction or make a big purchase or think about changing the structure of your business. Quite often people will walk in after the end of the year and say, look at all these things that I've done. What about the tax? And quite often there might have been a better way to have done it if they'd had the conversation first. Many businesses who go through a tax agent also have more time to lodge. So for many, it's not until March or May next year that they'll actually have to do their tax return. But in the meantime, I think it's really just getting your bookkeeping hygiene in order and making sure you've got the records in case the ATO comes knocking.
Okay, so bookkeeping hygiene, that's a good one. Forewarned is forearmed, and work with your tax advisor.
That's right.
Okay. Sometimes we see speculation in the media about what the ATO, the Australian Tax Office, might be looking at in small businesses, particular classes of spend that are under greater scrutiny from year to year. Are there any particular areas of focus that you're aware of this year?
Yes, the ATO is everywhere. We like to say don't play hide and seek with them. With their digital and their data capability growing, it's surprising how much information they have about your cars, your boats, your travel, all sorts of things. So really it's around making sure you declare the income. And for businesses, particularly small and medium enterprises, it's about separating the private use from the business use. There's a lot of tax implications when you use company property, you drive the company car, or even just take money from the company without properly accounting for it. And that can lead you into trouble with fringe benefits tax or underpayment of wages, or this thing called Division 7A, which is about deemed dividends from a company, and you can end up with a bit of a bill if you get it wrong.
Good advice. In terms of businesses that do operate in the cash economy, whether predominantly or exclusively, what should they be aware of?
Yeah, so there's nothing wrong with cash. It's legal tender, but you do need to declare it. And if you've paid for something with cash, you need to get your invoices so that you can claim it. The cash economy and what the ATO is calling the black economy is an area of focus, and they're pumping compliance resources into it. So they are doing a lot of reviews and audits. Really, again, they look at performance benchmarks, which is a bit tricky with COVID because a lot of businesses have changed how they are performing. But essentially, where you're looking out of the ordinary, or there are things that the ATO is seeing, like you just bought a Maserati or something, but you've got no tax to pay, they're the sorts of flags that the ATO is really going to come and have a look at. Alternatively, they also have particular industries of interest, like construction's always a perennial one, and things like hairdressing, where cash tends to be quite high.
Okay, so a Toyota Hilux might look reasonable in a construction business, but a Maserati might not.
Yeah, especially when you're saying you only earned $20,000 for the year.
Okay, so let's look at investors. The ATO has already flagged that they'll be targeting cryptocurrency investors because while the currency itself, the cryptocurrency, might be virtual, returns needed to be treated like any other investment return. Do you expect to see a real focus there? And what do you think investors should do if they're involved in cryptocurrency trading?
The ATO has been in that crypto space for quite a few years now. So they've been building their data matching capability and their work with the exchanges to gather information. And I think the recent FBI stopping some payments, I think, that were made through cryptocurrency for criminal purposes shows how far the government can actually reach into these types of exchanges and transactions. So what people used to think was hidden, that they didn't need to report it, or perhaps they were just simply not aware that cryptocurrency is treated as an asset. This is something that the ATO, given the recent rises in the value and the decreases as well, the ATO is just getting out there reminding people that they have to think about their cryptocurrency gains and losses. For investors, what that means is you need to keep good records. So when you paid for it, how much you paid for it, so what's the value? It's the same as a share or buying foreign exchange currency. And then when you disposed of it, how much was it worth? And were there any other costs that you incurred while you were holding that you can claim? Of course, if you're an individual and you've held it for more than 12 months, the capital gains tax discount might also apply.
And what is that discount?
So it's 50%. So you get to halve the gain. Similarly as well, unfortunately people might have bought at the peak and then decided to get out as the prices started to come down. Those are called capital losses, and they are also able to be put through your tax return as well. Using
cryptocurrency as an example again, sometimes the ATO might look at return on effort. For example, where should they put their best endeavours to get the maximum impact? Is there generally a threshold at which the Australian Taxation Office starts to pay attention?
It depends. I think where it's data matching, so you look at things like interest and dividends or cryptocurrency gains or losses, where they've got really good data, it's no cost almost to them to just pop it onto your tax return and say, hey, here's the bill. So in that sense, there is no threshold where they've got really good data. I think where things get a little bit more complicated and there's a bit more facts and circumstances that need to be checked It really will depend on their focus areas that we talked about before, which industries you operate in, how far outside the benchmarks you're at. They also have real-time analytics. They call it nearest neighbour. So as you're doing your tax return for individuals and sole traders in particular, but as it goes through their systems, if you're quite out of the ordinary, those returns will be flagged almost immediately. And before they even issue your refund, they might actually ask you a few questions and ask you to provide a few documents. So they've got so many different ways. I don't think it's really worth testing where their thresholds might be.
Gotcha. And with that data capability, is the speed of processing improving?
The ATO's always been pretty good. So they will start processing tax returns in the first week of July and start to release refunds. I believe it will be by the second week. Of course,
wow, that is fast.
It's very fast. They are a very efficient organisation. The caution there, though, is, of course, they don't have a lot of the pre-fill information, so you're taking a bit of a risk if your numbers aren't right. A lot of the data matching actually happens later on. So it might be 6 months after you've lodged your return or up to a year or so as the data starts to come in and they match it up. So there's that processing of the return component, but then there's also that follow-up stuff as information comes in. So things like rental tenancy information, as they're starting to collect that, as they start to match that up, they might go back and have a look at some of the returns people have lodged and just check to make sure they're doing it correctly.
Okay, you mentioned pre-filling there. What is that exactly?
So pre-filling, it's less so for business, but certainly for individuals and for sole traders and people who might lodge a tax return like with partnership income. You have information provided by banks, stock exchanges and healthcare providers that just pop up automatically in your tax return. The most common one, of course, is your income statement, which is to be known as your payment summary. And so if you're running a business through a company and you're paying yourself a wage, when your company finalises those income statements, that information will automatically pop up on your individual tax return all ready to go.
Pre-filled. Okay, so even though the processing might, say, be, as you mentioned, in the first week of July and finished by the second, it still doesn't prevent the mechanism for review later on. Is that basically right?
Absolutely right. So there are periods of review. They are relatively short, except in cases of fraud and evasion. The ATO only has a couple of years to go back. But once again, they're getting so quick with their checking and their digital capability, they probably don't need much more time than that.
We'll be back with more in a moment. I'm talking to Elinor Kasapidis, Senior Manager of Tax Policy at CPA Australia. Turning to property and property investors, house prices have shot up again this year, so any investors selling up will be needing to be wary of capital gains effects. What about property investors in general? Any tips for them?
I think, COVID-19 has been quite challenging for a lot of property investors, both commercial and residential. So we fielded, a lot of questions around, do I have to reduce the expenses that I claim, or can I claim the lost income, for example? So a lot of people should probably go to their tax agent and just talk through those. The tips are, no, you can't claim lost income, but if you do get, for example, an insurance payout for that, that does become assessable. If you haven't changed the use of the property, so if it's continued to be available for lease, then you don't have to adjust your expenses. But some people, for example, have chosen to shelter in their investment properties during the COVID period, and you're going to need to adjust your expenses and your claims to accommodate for that, so you're not overclaiming those amounts.
Okay, so by shelter you mean the investors lived in their own property?
Yeah,
gotcha.
Yeah. So for those of us lucky enough to perhaps have a holiday house out in the country or something that we'd normally rent out.
We can all dream, Elinor, we can all dream.
We can. So some people were fortunate enough and they might have spent 6 months of the year in that location. That means that they can't claim 6 months of that year's expenses like they perhaps might have done when it was available for rent. So it's just being really careful about those aspects. The other thing, of course, the difficulty around evictions and rental moratoriums. So even where rentals have been renegotiated or there's been a moratorium on payment or eviction, once again, the rules continue to apply as long as it's going through sort of that normal process. Your expenses will remain deductible. of course, you'll have less income to offset that against. And unfortunately, some people might generate a loss, which can then be offset against other income or carried forward to a future year.
In the last year, I've found that the ATO seems to be trying to increase engagement with business through webinars, question and answer sessions, articles, emails, their website. They've also seemingly expressed a desire to engage when a business is under financial pressure to work out a solution. Have you also seen that?
Yes, on both fronts. Most small businesses in Australia use a tax agent. Nevertheless, what the ATO is trying to do is to raise awareness, I guess, and that never hurts. If a business improves their financial and tax literacy, it informs them to have the right conversations with their tax agents and empowers them, I think, to make good decisions about their business. So the ATO really has got this dedicated focus for small business because they don't necessarily just want to come in and audit everyone and penalise everybody. They want, under a self-assessment regime, businesses to be making the right choices and to be aware of what they need to do. So I spoke earlier about good record keeping, for example. A tax agent isn't necessarily going to be in your business keeping the records. So having an awareness about what that looks like, the ATO is really trying to help businesses understand those sorts of things. In terms of financial pressure, I think at the last Senate estimates, the ATO debt book is over $30 billion, and a lot of that is attributed to small business. And, you look at our federal budget deficits, it's almost, not quite, but it's almost commensurate. So the ATO, there is this challenge. They were really sensitive and accommodating last year during COVID, and they still recognise that there are businesses, particularly in Victoria and in tourism and certain industries, that remain affected, but they do want to see engagement. For them, it's about having a payment arrangement in place, having a conversation about the tax debts and not burying your head in the sand, which can happen when things get difficult. So it's not working out a solution in the form of, the ATO will come down hard on you. It's about just reaching out and having that connection to make sure that they understand where your business is at, how you think you're going to work through some of those challenges, and certainly being sensitive and supportive of those businesses that are on the road to recovery.
Elinor, I've thrown at you a whole bunch of questions and you've answered them all without missing a beat. So thank you so much for talking to Fear and Greed this morning.
Thank you so much. It's always a pleasure.
That was Elinor Kasapidis, Senior Manager of Tax Policy at CPA Australia. This is the Fear and Greed Daily Interview. Join Sean Aylmer every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Adam Lang. Enjoy your day.